Stay tuned. This week we're going to have some financial fun and cover the most amazing performances of 2026 so far that also match a deep value criteria.
Yeah, deep value.
So it's a celebration of good performance on the first part. What comes next?
It really has. We'll cover current GDP estimates and then the AI debate, right?
AI danger.
Dangers and opportunities.
All right, stay tuned. Welcome to the August 31st, 2026 Advance Report for McGowan Group clients. Alex, we are 2/3 the way through the year.
Do you see that number?
That went fast.
That looks like 4.6% estimated GDP
Sorry, I messed it up.
for the third quarter of 2026.
4.6%. Tell us just how good that is.
That's really good.
It is more than twice the 20-year average for GDP growth for the United States.
Yeah.
And everybody missed it.
Yeah, a lot of people have.
No, people didn't know. I mean, we're 2/3 of the way through the third quarter, 2/3 of the way through the year. Funny how that works.
But here's a surprising thing. As we kind of get in, we're going to get into like what's really been performing well. And there's a theme in that outside of AI and S&P.
Whoa.
Well, imagine that.
Okay. Yeah, because everybody's focused in this one area, and it may be too much in the sun, and we'll tell you why.
That's right. Obviously,
Whoa.
yeah. Obviously, we've had a big move. We're going to get into the next chart. So how have stocks performed under this environment? Obviously, there have been some really big winners. But crack spread is what is the price?
It explains the really big winners as we get to them.
Yeah.
Okay, so you want to put this in context. Okay.
But the crack spread is the price above the barrel of oil for a refined product, right?
How much profit do I make if I produce a barrel of refined product?
That's right. That's gas, heating oil,
Look at
diesel.
this. A low of $4, and it hovered for a long time way down here, like $20.
That's really why nobody likes to build refineries, right? Because you sit down at this bottom for so long.
Well, they shut, this is when the economy was shut down, right?
Yeah.
And what happened here? Putin invades Ukraine.
Right.
And that it went over $60 profit per barrel. But then it came right back down.
Yeah.
Right back down to about the $20 level.
You didn't have major disruption in refining capacity around the globe. Right now, you have some major disruption in refining capacity.
Russia's refineries, the reports are they're offline till 2030.
Yeah, that's right.
That's the energy infrastructure. God bless Texas because...
Now, refineries are being built, right? They're building new in the United States. Hopefully that gets online sooner than later for the gas prices anyway. But it's possible that these crack spreads will stay at an elevated level for at least the near future.
And this is a record for the highest and also the longest sustained above 50.
That's right.
Right in here. That's what that tells you. Now, that'll also explain as we go through the top performers of the year, not necessarily all energy infrastructure, but you'll get the point as we go through. And Alex, there's your benchmark.
S&P plus 14%, pretty good.
That's good. And the S&P benchmark, I've always found this in wealth management, right? So if the S&P is really good, everybody says, I should be beating the S&P.
Yeah.
Because you're so smart, right? And sometimes it's better to underperform. I'll tell you why. Because if the S&P was a minus 14, then the benchmark would move. It wouldn't be the S&P anymore.
That's right.
It would be, I don't want to lose money.
That's right.
And so you have to balance those two perspectives as you build a portfolio. But 14%, that's the S&P. What did better?
Energy infrastructure, or this is the State Street Energy Select Spider ETF, so it's all energy.
S&P Oil and Gas Index.
41.5%.
That's just it round
So
it. It's 40. Yeah, go ahead.
Okay, 42. I'll round it to 42. But I want to make a point here. The time to buy energy is not today. It was years ago, right? Because the assets were so cheap with extremely high cash flows. Everybody's like, this thing's going to die. Nobody's going to use energy anymore. Well, that premise was false.
And you're still at about 7 times cash flow for sectors of that.
Yeah.
And how long does cash flow stay elevated? The premise after Epic Fury was that, okay, the Strait of Hormuz will reopen, oil prices come back down.
Mm-hmm.
And I have something interesting here.
Well, there's something else, though. We talked in our teaser that when you look at deep value, look how well deep value has performed. Energy and energy infrastructure, oil and gas, the producers all fit that category several years ago, still do to some extent. And you're able to outperform with great assets that pay great cash flow as part of your portfolio strategy. And this proves that that's true.
That works. And there'll be a time to start to harvest.
That's right. But this is, look, that's a giant cup right there.
Well,
that looks pretty good to me.
Oh, you mean this? You digested this gain.
Yep.
Notice this was true of the defense stocks as well, okay? Before Epic Fury, you had an inexplicably good run in energy infrastructure. Now, we're like, okay, finally, they're recognizing that's the cheapest sector. But the defense stocks all rallied to this huge peak before Epic Fury. So there's some leaking going on, some information leaking. It's suspicious.
Okay.
Yeah, depending on the midterms, you may get to hear some about that. But anyway, the defense stocks, they went way up, and you'd think at Epic Fury, okay, I go buy the defense stocks. No, they had a settling down. That may be over, but that's a different subject. We're covering year-to-date winners now that we're 2/3 through 2026. Whoa!
Dell Technologies. This also fit in the value cap at one point, right? And
it was miserable last year.
I remember.
They were sandpapering our heads. Remember, it's not a recommendation for your portfolio. Till you come down and get a plan, you go to the McGowanGroup.com and you send us the information. It says contact us here, and then Alex and I will follow up, get you on the calendar.
So, yeah, well, I just want to kind of run through
you get
the
a
story.
new wealth management plan.
Yeah.
Okay.
That's the plan. Do that.
275%.
275%.
This thing was like 12 times earnings.
When we bought it, or is it still 12
Yeah.
times? Yeah, when we bought it, it was cheap, and it stayed cheap while everything else was moving. Well, it finally got some legs.
We sold more of it than the money we put in.
That's
We do partial harvests. That's a good portfolio technique. You know, when you get boom, right? You wake up there, you're like, well, maybe we take a little off the table.
just a little bit.
Whoa!
Here's your.
Now, we don't always get it right because we've had some stuff underperform. So I'm going to cover that for compliance
purposes. Thank you. Thank you for that.
Sometimes we get it wrong.
These are your
and you have
refiners.
to admit it or it'll mess up the portfolios.
Yeah, these are the refiners. Refiners have done very well. Marathon Pete, Valero Energy. What's interesting about this is our friends in Houston, which we talk a lot about.
Yeah.
Right? They were early buyers of this.
They nailed it.
They nailed it. And so we benefited from that just from having them in our portfolio.
They're smart. And well, I looked up the refining capacity when Katrina was showing me all the drone footage.
Yep.
The beautiful Katrina McGowan. That, you know, there were videos coming out of Russia as the Flamingo drones were just taking out the refineries. And they're 7% of the world's refining capacity.
That's a lot.
They were a net exporter, as is Texas, right? Mm-hmm. But Marathon and Valero, they have 3 times the domestic refining capacity of Chevron.
Oh, wow.
Yeah. So they're heavy refining. So when that crack spread comes back down, you probably wanted to have taken some off the table.
Right. Yeah, you might want to take a little off the table.
Okay, so let's go to deep value.
Okay.
Before I go there, a criteria that says how much cash flow per share does a company generate, right? And that's the selection process for this particular exchange traded fund. But 42%,
Hard to argue with that.
that's deep value. And it's not all energy, of course. So then here, whoa, that's energy.
Yep. Plains All American.
54%. They're still, that's like 2.5 times current cash flow. Now their cash flow will go back down because they have wonky cash flows.
Yep.
Because they have a lot of storage. But in any case, wow, that is a multi-year breakout, by the way.
Mm-hmm.
And so you don't have many dissatisfied shareholders putting a lid on the price every time it spikes.
Yeah. Yeah,
And-
that's true.
All right, so, uh-oh.
All right. So
Okay, you're going to cover the AI dangers.
Yeah, so there's an AI debate. Obviously, this is from Wall Street Journal. $3 trillion estimated off balance sheet related commitments, particularly for the big hyperscalers. And all that means is that they have future spending commitments that are not reflected in the balance sheet or the income statement today.
It says here, future leases, chip and equipment purchases, data center capacity, power and construction contracts.
This is the big risk.
That's forward expenses,
Yep.
and it's a liability.
But it's not on the balance sheets yet.
Okay.
That's the rub, right? So one of the big dangers in the AI cycle is for many, many years, for decades, you had these tech companies buying back shares. That was really, and paying a little dividend, and that was really how they're returning shareholder value back to shareholders. Well, now they're borrowing money, issuing shares, and they're going to have all these forward commitments. They're already burning through all their free cash flow as of right now. They're negative free cash flow, and they have $3 trillion of more commitments to spend coming forward.
Ouch. Okay.
So that's the danger.
So that was one report that you researched.
Yep.
Now you're going to explain this, and you're going to give us another potential outcome because we've covered the warning.
That's right. So if you look at, everybody kind of thinks of this as the 2000 dot-com bubble. They overbuilt, capacity couldn't come in. Well, there's another question that comes into play here. In 2008, credit and real estate expansion, you had all these adjustable rate mortgages, all with reset cycles going into 2007 and 2008. When the rate of change started to happen, when all these started to reset, even before you got to the peak resets, so we call that kind of like a deceleration of,
Yes.
right? That's when you had the real collapse. In the AI market space, you have
rolled, it quit growing as fast.
Yeah.
The rate of change, rate of change, rate of change. So delta, delta, delta. Rate of change of the rate of change and the rate of change in valuation.
Well, you also had the rate of change of the cost of the mortgages because of that ARM piece occurring all at once in a space where none of those people could pay the higher rate, right?
Okay.
So you have kind of those two things working together. In the AI space, the big argument is, well, OpenAI, Anthropic, and others in the large language model space are going to be taking over take-or-pay contracts into these data centers. They don't have cash flow, right? They have cash burns.
Okay.
So if they end up in the data center space with not any cash flow, there's a real risk of them just imploding. And the backstop for all that are the big mega cap tech companies.
Wow.
So that's the big danger. I think what's interesting, if you look at the narrative around these two things, is can the demand in the next year or two exceed the supply that's coming online and actually get some of these companies to positive cash flow to pay these leases? It's a gamble, right? I think that's where the gamble is. And a lot of people are saying, well, maybe they make it. I think there's a lot of risk there.
Well, in our own examples, right?
Mm-hmm.
So we have the team of 9, the team that cares, the team you want on your side, by the way. So we started using this year and a half ago, was the first uses of AI for wealth management. One is presentations, graphics,
Yeah.
data mining, research reports, right? Processes so that you're more efficient and the clients get better service.
Mm-hmm.
Now it's embedded in the systems, right?
Yeah.
Behind the firewall, confidentiality, lockdown, protected. But it also allows, for example, the upgrade of a wealth management plan, upgraded projections that are relatively easy to run with the client.
Mm-hmm.
Well, that's embedded now, right, in the wealth management process, in addition to portfolio construction. In the portfolio construction debate, the AI is there. Here's my point. If they came back to us for our main AIs
Right.
and said, you need to pay us more,
Right.
they've got pricing power. They could probably double what they're charging us and we would still do it.
Yeah, we're not charging us very much. Right.
Well, I'm just saying that the other side of this has pricing power in so they're going to bifurcate, right?
That's the
Now,
opportunity
the whole
side.
thing may reprice, but they'll bifurcate into survivors and not survivors.
Yeah.
And OpenAI is the poster child of overspending and burning cash.
Yeah, I think
So I wouldn't do that IPO.
65% of their revenue they're burning in cash burn.
Okay.
Now, I do want to make a shout out. This came from Groundbreaker Research on Substack. So we thank them for putting together some research that we could use.
And you put it into better format.
Yeah.
You used AI.
There you go.
All right. Well, be sure to subscribe. And if you like the broadcast, please tell us. That makes us feel better. And we'll be back next week to try to earn not just your business, but also your loyalty. I hope you look forward to joining us each week. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.